All right, welcome back to the third part of our Explainer series. Today, we're totally dismantling what is arguably the biggest illusion in all of investing. We are tearing down that wall of subjective, gut-feeling market opinions and replacing it with hard, objective, actionable math. Seriously, if you've been relying on your instincts, the latest news headlines, or some hot stock tip to manage your portfolio, this explainer is going to fundamentally change how you view the markets from here on out. Here's a quick look at our roadmap for today. 1. The stock picking myth. 2. The 6 market types. 3. The math of the market. And 4. Matching systems to markets. Let's jump right in. Starting off with Section 1, the stock picking myth. So let's confront a massive trap that almost every single investor falls into at some point. I want you to honestly ask yourself, how much time do you spend obsessing over researching the quote-unquote right stock? If you're like most of us, you've been fed this idea that finding that one magical company, the next Apple, the next Microsoft, is the ultimate golden ticket to wealth. You probably spend hours reading reports, watching financial news, just endlessly hunting for that needle in the haystack, totally convinced that your entry point is everything. We kind of become like this tiger, right? Totally hypnotized by the hunt for the perfect stock, walking around in a daze, constantly muttering about earnings ratios and new product launches. But here is the really stark reality that Dr. Van Tharp points out. If you look at the original 30 Dow Jones Industrials, guess how many survived into 2009? Just one. General Electric. That's it. The rest went bankrupt, got dropped, or were absorbed. Picking a stock and just blindly holding it forever, that isn't a strategy, guys. It's practically a lottery ticket. And this brings us to a frankly mind-blowing experiment conducted by Tom Basso and Dr. Tharp. They literally proved that you could enter the market completely at random. I'm talking flipping a coin to decide whether to buy or sell. And you could still make consistent money over a 10-year period. Crazy, right? But how? Because picking the stock is practically irrelevant compared to the actual mathematical rules of your exits, your risk management, and your position sizing. Your brilliant entry gives up any real advantage if you have absolutely no idea how to survive the ride. Which brings us nicely to Section 2, the 6 market types. So finding a magic stock isn't the answer. What is? Well, it's the environment itself. The reality is that the market is not just one giant monolithic thing. It's more like a constantly shifting weather system. According to the data, the market always falls into exactly one of these 6 types. It's a combination of direction, meaning is it going up, down, or sideways, and volatility. Is it loud and volatile, or is it quiet and calm? Think about it. You wouldn't wear a heavy winter coat to the beach in July, right? In that same way, you absolutely shouldn't trade a quiet bull strategy in the middle of a volatile bear market. All right, Section 3, the math of the market. Let's ditch the gut feelings and get into the absolute hard math behind this grid so we can identify these environments completely objectively. To determine our current environment, we analyze a strict 13-week rolling window. Why 13 weeks? Well, it represents exactly a quarter of the year, which gives us a really solid trend-revealing sample size. We use this 13-week window to measure both the direction of the market and the noise level, and we're referencing decades of historical data going all the way back to 1950. Let's look at the very first calculation, direction. Historically speaking, the average change over a 13-week window is about 5.53%. So here is your ironclad rule. If the absolute value of the change over the last 13 weeks is greater than 5.53%, the market is trending. If it's up more than 5.53%, boom, you are in a bull market. If it's down more than 5.53%, you are in a bear market. But if the change is less than 5.53% in either direction, you are stuck in a sideways market. See? No guessing required at all. Now we need to figure out this second half of the equation. Is that exact same 13-week period volatile, or is it quiet? To do this, we use a brilliant metric called ATR, or Average True Range. ATR looks at the daily price extremes, the highs, the lows, the closing prices, to effectively quantify the market's noise. Basically, it tells us how wildly the price is swinging on a day-to-day basis as a percentage of the closing price. And that gives us our second vital number. Over decades of data, the average 13-week ATR as a percentage of the close sits at exactly 2.87%. The rule here is incredibly straightforward. If your 13-week ATR is above 2.87%, the market is classified as volatile. If it's below that threshold, the market is quiet. You combine this with our direction calculation and you instantly objectively know exactly which of the 6 market types you are standing in right now. And finally, Section 4, matching systems to markets. Knowing the market type is only half the battle, right? The other half is what you actually do about it. Dr. Tharp shares this great story about waiters and bartenders back in 1999 who thought they were absolute investing geniuses because they were buying tech stocks that just went straight up. They were in a bull market. But when the environment abruptly shifted, their accounts were completely wiped out. A buy and hold strategy works beautifully in a quiet bull market, like the one we saw in 2003. But applying that exact same system in a volatile bear market, like the massive crash of 2008, it will absolutely devastate your account. The environment dictates the system, not the other way around. The real secret to consistent success isn't finding one single holy grail system that magically works in all conditions. Honestly, that is a fool's errand. Instead, you need to build a wardrobe of non-correlated strategies. You need a system that thrives in a quiet bull. You need a completely different mathematically tested system with a positive expectancy for a volatile bear. And hey, maybe you just step aside entirely during a volatile sideways market. The core goal here is to mathematically confine your system to the exact environment it was originally built to dominate. So I'll leave you with this final critical thought to ponder. Take a hard look at your portfolio right now. Are you stubbornly wearing a swimsuit in a blizzard, just hoping the weather will eventually change to suit your outfit? Or is your strategy perfectly mathematically matched to today's reality? Stop hunting for the perfect stock. Start calculating your market type and align your systems to the math. Thanks so much for joining me on this explainer, and I'll see you next time as we continue unpacking these professional trading concepts.